During a year that saw natural disasters and high rates, sticky inflation, now a new challenge in the mix for 2026. How do you grapple with the high price of data centers? For more on what to expect in the year ahead, let's bring in Joshua Shanker, insurance analyst at B of A Securities. I mean, really what I'm hearing, Josh, is that the insurers see this as a big driver of potential growth because the facilities themselves are massive, and it may take layers of insurers, like lots of insurers coming in together to be able to cover them? Or do you think that there's another way around that the prices of that kind of insurance might be so high that, you know, you have the likes of Google just deciding to self-insure?
I think it's a combination of both. Thanks for having me, Contessa. The truth is that it's a great thing for the industry. Complicated risks are what the industry wants and needs in order to justify why it's doing a service in terms of the global economy. And so here's a new complex risk of a lot of insured value coming on. It's a great opportunity for the industry, for the brokers, for the insurers, for everyone in the mix, and they welcome complexity. But you're right. Companies like Google, for example, have a tremendous amount of capital and the power to self-insure. And if the insurance brokers conclude that the price being offered to insure these data centers is expensive, there's the opportunity of creating structures of self-insurance to avoid that risk altogether. It doesn't mean the industry can't benefit because the industry also designs those structures, but it does mean that the underwriters might not be able to wet their beaks on this risk as much as they would like. But overall, a big, new, exciting, complicated risk, that's great for the industry. I think it's a positive thing in an industry where pricing generally isn't going the right direction. Perhaps ultimately the actual influx of new risk is positive, offsetting that trend.
I want to talk a little bit about, now people, don't fall asleep when I say this word, reinsurance. This is insurance for insurers. And because reinsurance rates skyrocketed over the last few years, it's part of the reason, not the whole reason, but part of the factor in why property insurance premiums climbed as well. Guy Carpenter is just out with a note today that says those rates are going to moderate. The January 1st renewal deadline comes up this week. And what we're going to see is businesses, insurance businesses having to pay lower or needing to pay lower rates. There's such an influx of capital. These reinsurers have made great profits. Explain the mechanism for investors about how that works.
Well, the reinsurance is the tip of the spear. And so the volatility is extremely high. Long term, that is a huge growth industry. If you believe that climate change is real, and we do, there's going to be more and more storms to insure over time. We got to a point in 2024 where the price of property catastrophe reinsurance in particular reached an all-time high. And it's going to be down for the second year in a row this year, off a very, very high amount. And so the price of reinsurance is still expensive. It's not as expensive as it was 1 year ago. But the fact is that if managed correctly, the opportunity to make money in reinsurance and also to give a healthy market where catastrophe can be managed, it's a great business overall.